The graph that you see right now is called the Wilshire GDP indicator, also known as the Warren Buffett indicator, which he has described as probably the best single measure of where market valuations stand at any given moment. So in 2025, this number stands at over 200%, where in the past Warren Buffett has stated that if this number rises above 100%, the market is already considered overvalued. This number is calculated by combining the total market value of all US companies and then dividing it by the country's gross domestic product, which is the size and overall economic activity of a country. So could buying index funds in 2025 turn out to be a huge mistake that investors are making? With the S&P 500 reaching record high levels, it is pretty reasonable to think that now is a bad time to buy index fund-based ETFs. So many investors hesitate to buy in these markets due to a fear of correction, which is something that I have experienced during my own investing career. So in this video, I want to remove all emotion and analyze critically what legendary value investors think on the current market valuation, and determine if investing in index fund-based ETFs is still a good idea at these higher levels.
Nowadays, the structure of the markets and where everything is priced will give you probably a return in the vicinity of 4%, 3%, okay, something that might not equal inflation, probably it'd be very close, and then you have to pay taxes on it.
So that was Ray Dalio, and for those who don't know, he is the founder of the world's largest hedge fund, Bridgewater Associates. And in the clip that you just saw, he has stumbled upon the same issue, where he believes that the market is extremely overvalued at the moment. So he predicts a very low stock growth in the next 10 years, something commonly known as a lost decade in stocks. A return that in his mind might not even beat inflation. So let's look at this interesting graph to further present Dalio's point. This is known as Shiller PE, which shows the average inflation-adjusted earnings from the previous 10 years of the S&P 500 index fund divided by its current price. And this figure is now close to 40, which means that people are willing to pay close to 40 times the yearly earnings to buy the index fund. Where in the past, on average, people were willing to pay just 17 times the yearly earnings for a piece of the S&P 500. With only the period between 1998 and 2001 having a higher figure, which was during the dot-com bubble known for the extremely overpriced internet companies with unrealistic valuations, which plummeted the Nasdaq 100 78% down from its peak, which is an index fund that tracks the 100 biggest tech companies. Well, so far in this video, everything that I presented as an argument points out to staying away from investing in index funds. However, I want to first present the knowledge and opinions of a very special investor who has had one of the biggest influences on the stock market. And that person is Jack Bogle, who is the founder of the Vanguard Group and is credited with popularizing the index fund by creating very low-cost, broad market-based ETFs, thus allowing people to easily and cheaply invest in index funds like the S&P 500. So we can say that he helped more investors to create wealth than anyone else. And let's hear what he has to say.
On that note then, let me close with 5 simple principles, a few ideas of what you might want to think about, principles of investing that may help you. First, invest you must. The biggest risk is the long-term risk of not putting your money to work at a generous return, not the short-term, but nonetheless real risk of price volatility. Even though stocks seem very high, consider what I said in my book, a little plug there. Never think you know more than the market does. You're apt to be wrong if you do.
Don't think you can predict the market. What an interesting take. Well, he might be onto something here. So let's look at this interesting chart by First Trust called the History of the US Bear and Bull Market. What this chart represents is all the yearly percentage changes in the US market, where you can clearly see that in the vast majority of years the market has increased in value instead of declining. So what he is saying is that staying out of the market may be a grave mistake, regardless of the price, since you will probably miss out on all of the good market years. So not investing could be costing you much more. Does that mean that just dumping your money into the market, regardless that it is currently trading at an all-time high levels, a good idea then? Well, in the past, even if you have invested at every market peak, just before a crash, if you hold your position, you would still have made a positive return on your investment. Regardless of that, it is still probably not the best way to do it, since you will miss out on the market dips which could have produced you with a much higher relative return. Then how should you invest then? Well, there is a strategy which is created just for that, praised by value investors as the ultimate passive investment strategy known as dollar cost averaging, the S&P 500, which has produced a compounded return of over 10% per year since the creation of the index in 1957, which means investing the same amount of money in an S&P 500 based ETF at regular intervals, for example once every month, regardless of the price. In that way, you both invest and benefit during the highs of the market as well as its lowest points. So if you look at something called the SPIVA indicator, you can see that for the last 15 years, this strategy has outperformed about 90% of all actively managed funds in the US. And the same thing is also true for all developed countries around the world. So, in the very start of the video, we mentioned the Buffett indicator, showing how overvalued the market is. So let's hear what he has to say about index fund investing.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
So does that mean that Buffett supports Jack Bogle when it comes to investing in low-cost market-based ETFs?
Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, and as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole.
But the real question is if that is still applicable for people starting their investing career now. Back in the days when he started investing, this indicator has never seen valuations like today. So then how would he invest today if he had to make this choice all over again and invest his money for the very first time?
There's no, if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Well, there you have it. He still believes that investing in the S&P 500 is the best strategy for the passive investor who does not want to spend time doing company valuations and take the additional risk of investing in individual companies. However, if you want to learn how to pick and evaluate individual companies, you're in the right place. Since in this channel I explore the investing strategies and philosophies of legendary value investors. So check these videos where I explain some of these concepts in details.